Today, we decided to leave our policy interest rate unchanged.
Federal Reserve Chair Jerome Powell on Wednesday announced that the U.S. Central Bank will keep interest rates steady for now, following a two-day meeting that ended with a unanimous policy statement. But in new economic projections, the Federal Reserve did signal that further rate hikes were likely before the end of this year.
Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized.
The U.S. Central Bank is attempting to rein in inflation, but a stronger than expected economy and job market continues to push prices higher. The Fed's new projections, adding a hawkish tilt to Wednesday's interest rate decision, show policymakers expect rates to raise by about half a percentage point by year's end.
I don't think we have any surprises here today.
Liz Miller is the president of Summit Place Financial Advisors.
By this morning and yesterday, it was pretty clear that the Fed would pause. We were thinking that the current inflation data could have been used to raise rates if the Fed wanted to, but clearly the message was we want to watch more data before we make the next move.
The higher rate outlook coincides with an improved view of the economy, and consequently, slower progress in returning inflation to the central bank's 2% target. The Fed's decision Wednesday snapped a string of 10 consecutive rate hikes delivered as the central bank last year began scrambling to address soaring inflation.